Is the stock market more volatile in presidential election months than in any other month? In today's video, we are going to talk about just that. The presidential election is coming up for 2024, and I've been getting the question, hey, with November coming up, it seems like things are going to be pretty crazy. Should we just sit it out with all the volatility? It seems like the market could go haywire. I don't really necessarily want to take any additional risk. And so that becomes a question, which is, well, is the month of a presidential election with so much happening different than any other month in the market? Today we're going to look back at about 100 years worth of history and not necessarily answer the question what's about to happen, but again, give us a little bit of a lesson so we can have some bigger picture context. Okay, so let's look at this chart here. So what we have is this is a normal distribution of return. So this is every single month since 1926. And as you can see, all the bars on the far left are really bad months, so down 20% or more. On the far right is up 20% or more, so there's not many of those months. And then what happens as you move towards the middle, anywhere between -5, +5, right, you're starting to see the majority of these months show up. And so what does that mean? It means in any given month, anything can happen, but for the most part, if you look over a long enough time period, your returns fall within a pretty reasonable range. So what about months of the election, right? Those could be seen as more volatile. Where do those months fall? So as we bring up our red dots or our red bars and our blue bars, reds meaning how does the month look when the Republicans won, the blue bar being how does it look when the Democrats won. Well, as you can see, these bars or these months are pretty normally distributed. Where are they not? These bars are not over on the far left or over on the far right, meaning you have a really bad month or a really good month. In fact, there are none of those. So what happens is, based on the amount of presidential election months, it's kind of a normal distribution. And I would guess if you were to just play this out as every single other month, your distributions are going to be pretty similar to all the gray bars. And so what does this mean? We have our blue bars spread out on the left side. We have our red bars spread out on the left side. They're both on the right side as well. What does this mean going into the election? Well, more than anything, what it means is no one knows what the market is going to do next month. Sometimes it's negative, sometimes it's positive. And that's with any month investing in the market. Investing is a long-term game. Now, what is for sure going to happen is while no one knows today, something is going to happen in November. The market is going to go up, it's going to go down, and all the media is going to come and tell you why it happened, and it's going to seem obvious in hindsight because that is always how it works with investing. But no one knows what's going to happen today, and we can only invest before things happen, not after they happen. And so hopefully giving you this context and letting you know that presidential election months aren't all that different than regular months can allow you to stick to your long-term plan as an investor. I hope you found this helpful, and as always, thanks for investing your time with the Personal CFO.